All right, and so we are officially live, broadcasting only on onedealaway.com/live. This is Money Matters. My name is Neb, and today we're going to be talking a bit more about what's happening in the economy overall. Actually, to be honest with you, we're going to be discussing a bit about what's going on in the markets and what can you expect for today, maybe even this week. We don't know exactly how things are going to turn out. But what we do know is that things are changing, things are shifting, and it's time for us to understand what's happening. So, we're going to be looking at the global debt and what's going on over there, as well as what's happening with the private equity companies. As you know, we follow some of those things and talk about things and look at, hey, where are things moving, where are things going, and what's happening in that area because those are jobs. Those are things that provide stuff. So we're going to be looking at the bigger picture of the market, and I hope that you will actually enjoy learning about it. So a bit about it, as they say. And we're going to be trying to understand, what's happening. Where are we in the market? Where are we, going to? And I know it's an election year. We have election happening in what? Well, given that it's almost end of September, yikes. We have a little bit over a month, so what, about 5, maybe 6 weeks left before the election, and it's going to get rough. So, typically, markets actually pump on up, but this has also been an incredibly politicized year that we don't know where things are going to go. We've also been talking about the fact that crypto is very much attached to the stock market. And while we were learning about crypto, there was not much happening with the market because, well, there was not much happening with the market because it's a weekend. However, there are developments that you absolutely need to know. And so if you're curious if it's going to be a red day or a green day, you definitely want to stay tuned in today. All right, let's do this. And welcome, welcome, welcome. So, happy Monday to you. Let's get started with the things. So, first off, I do want to jump into the crypto market. I know we've looked at it already this week, but I think it's important because you're going to see something very interesting. So, I want you to pay attention to the trends of where we are, and then we're going to talk about it. So, when we switch over and take a look at the top 100 cryptos, you will see a sea of red. Okay, there's a little bit of green here and there, but predominantly sea of red. I mean, just right. So that's an interesting piece. Clearly, we can say that it's a mostly red market with the top cryptos going down. Of course, we do have a few that are going up. Orchid up almost 30%. Cello up almost 20%, and then after that, it's single digits for Divi, Digibytes, Hyperion, Unus, SED, LEO. I think they can try to come up with an even longer name next time. And then Die. When Die is your positive for the day, it's not a good day because Die is, well, pegged to a $1, right? So it's supposed to be the stable coin. So if the stable coin is your positive, that's it. That's it, y'all. There's nothing else. After that, we just go into single digit negative and, keep on riding that puppy all the way home, and going into, double digits. And of course, I'm sure that it gets even worse from there. Well, I don't know that there's like worse than double digits, but double digits is pretty darn bad, right? But then, so you're seeing that it's predominantly red day. So it's predominantly a bear market day, right? Which, if you have a great project, if you have a great thing that you're interested in, for me personally, it's kind of like cool of, okay, well, I can just, dollar cost my average myself a little bit better into the stuff. But you also want to be a bit careful with this stuff. So, anyways, not financial advice. Nothing I say here is nor should be used as such. If you need financial advice, find somebody who is certified to give you that. Okay, so interesting piece also to take a look at is here's silver. Now, what's going on with silver? Well, on comics, it's actually going down over the course of a day and 5 days and the month, but of course, green on a 6 month. So we have been on a sort of downtrend. Now, of course, we've been going on up until early September, and then things have started to go down. You want to remember early September up, since then down. Pay attention, this is silver, $26.46. Then we have gold. Let's take a gold in, right? Gold is green for the month. What did we have? We had a high early September and then down. Now, of course, we've had like up and down and stuff, and it's not severely, if you really look at it, mostly flattish, right? Mostly flattish of it, because here is that. Where's my September? No, this was August was the high. Sorry, I apologize for precious metals. Early August was the high, and then it's kind of like come down and it's going sideways. So we've been in that 1900 range for over a month now, which is fine. That's a normal piece. Then you have Russell 2000. It's down for the day. This is the futures. This is the futures market. So you can expect that the non-futures, meaning during regular hours, where most of Robinhood's could actually play, it could potentially be red. Now, there's a strong correlation. It's not guaranteed, but there's a very strong correlation that when futures market perform one way, that the daytime performs pretty much the same way. So you might want to get ready for a bearish day. Now, here's an interesting piece. When we take a look at the Russell 2000, you will see that we hit a high right here in June, right? And which you know is sort of we've broken that, but now we're below that price. So we've kind of hit over here slightly above the all-time high, and have gone down and going sideways. And over the course of a month, you will see that from early September we are basically going straight down. So Nasdaq futures is also red, also pretty much the same story, not exactly. So we hit a new high in early September and have been going down ever since. If we like a look at 1 month, you can actually see the chart very easily just go straight down. Okay, now Dow Jones Industrial Futures is also down. So again, prepare for a bear market today. Again, I can't promise or guarantee anything. My crystal ball broke years ago. We don't know how to fix it. So I'm going to be guessing just like the rest of us. Okay, so early September, top, hit on down, right? And you can see it right over here. There's the early September. And we've been going down right now, hitting, what is this? Basically the early June. So we wiped out 2 months completely. But then again, in my humble opinion, none of this should have happened anyways. And then we go into the futures for S&P 500, also down, and also the exact same story. High in early September, and since then we are going down. We are going down, and that has been the story for the past 3 weeks now. 3 weeks that we have been going down. So maybe we're not experiencing the crazy March dumps and stuff, but we're definitely going down. But what is actually happening? Well, that's an interesting piece to take a look at, and this is where the first article comes to play. And it talks about exactly what we've just been discussing. The fact that things are down, and he's saying that the giant 5 stock index, Apple, Amazon, Google, Microsoft, and Facebook, is negative 16% from high. Apple is negative 20%. And what about the rest of the market? So, the giant five stocks, Alphabet, Amazon, Apple, Microsoft, and Facebook, as of the close on Friday, fell 4% during the week and are still down 16.2% from their collective closing high on September 2nd, a drop of $1.27 trillion dollars in combined market capitalization. That is crazy. That's, what did somebody was saying, or I saw it in a hotel, cray cray, and I'm like, no, please don't. But it is absolutely insane, and you can kind of see what happened. So we're back down to this July, which actually we saw that we're back down to, well, I don't know about these five. We didn't look at that. We just looked at the entire thing. But when you see the rest of the chart, you will also understand that the entire thing is these five stocks. So let's continue. Well, you have all of that stuff, and so now, they kind of added the five more high flying stocks: Nvidia, Netflix, Tesla, Intel, and Salesforce into the whole thing. And when you put those in, you will see that we're actually down only 15.1% as opposed to 16 point something. The reason for that is because Tesla actually jumped 19% during the week, but it's still down 11% from its closing high. And then Intel rose 1.6 and Nvidia was up as well 0.5. So while the rest of them fell. So this is kind of what we can take a look at what's going on for the 10 stocks in this sort of the top tech stocks that are the market, in my humble opinion. They shouldn't be, but they are, and you will see why in just a moment when we take a look at the chart. So you will see what's happening over here. All of them are down, with Intel clearly being down the least at 4.3%. Tesla is the second least at 10.8. Then Microsoft is negative 3.5. Salesforce negative 13.7. Nvidia negative 14.9. Alphabet negative 15.5. Netflix 15.6. Amazon 16.3, Facebook 16.5, and Apple clear winner in the losing game of negative 20.3%. And then what happens if you take out these tech stocks, 10 stocks out of the market as a whole? This is what you get for the Wilshire 5,000, which is basically the entire market, which is not even 5,000 anymore, but whatever. And you take it out, and you can see that basically we are right back to the 2019 levels, right? So forget all the gains that we got in the late 2019s and early 2020s. Forget all the losses that we experienced in the year. It's just sort of like, we skipped a year. We skipped a year, right? We skipped 15 months or whatever. But how did the rest of the market do without the stuff? So this is right what the market cap looks like over here. But how did the market do? And as of the close on Friday, the rest of the market, which is green in this particular thing, is down 6.4% from February 13th. So as you can see, when we take a look at the 10 stocks, which is the red line, they're the ones who have been performing on up. Everything else, the entire rest of the stock market, is sort of recovered, but not really recovered since the February. So when we went down and we crashed, we've actually kind of gone up and sort of sideways and moving on sideways potentially for the next leg down. However, the top 10 stocks, the top 10 tech stocks, right? The 10 tech stocks, whatever, are the ones who have actually been driving everything on up. And so that's what's been driving these big indexes up onto folks. So this is one of those things that is very, very interesting and very, very scary. All right. So talking about the tech stocks and what's happening in that neck of the woods, there is something very interesting that also has happened. You've likely heard of Nikola, which is the competitor to Tesla, which I think is really funny, personally, but whatever. But these are the sort of like the trucks that are smart and have like the batteries, blah blah blah. Well, it turned out that there was some sort of potential fraud, right? More likely than not. And the SEC is investigating and stuff. And so here we go. We received the news that, well, the founder is unexpectedly resigning. Well, yeah, because it's a fraud, right? And there's an SEC probe. Well, yeah, because there's a fraud. And then the stock plummeted 25%. Yeah, because it's a fraud. So the reason I share this with you is not to beat up on Nikola. I know not much about it. The reason I share about it is the risks that we end up taking as individuals when we buy in particular stocks, right? When we buy in particular things. Because you don't know what they're going to do. You buy into the stock thinking that, hey, it's a really good thing. And then it turned out that they lied and they cheated and they omitted. And, then the owners, like, sort of like disappear and SEC gets involved and you are left holding the bag. So that's one of the reasons that I don't like necessarily the stock market as much, because you end up holding the bag, right? And so you get a little bit of benefit when things go up and a lot of downside when things go down. And that's kind of where the experience that I have had is. Now, you let me know what you think and how you feel about not just Nikola, but also holding stocks. I could be wrong. You might, you absolutely love it. And if you are watching this live, feel free to sign in and put it in the chat. And we can, of course, do the Q&A at the end. I forgot to say that at the beginning. And if you're watching this on YouTube, put in the comments, smash the like button, subscribe, and hit the bell button to get notified when we go live, which is, well, just about every single day. Oh, wait, it is every single day, with the rare occasion where I am not around, and then we don't. But for now, we have been coming on very, very regularly. So here we go. This is kind of where my challenge is. Again, has to do with stocks, and I'm curious to hear what your thoughts and opinions are. And talking about all of that, we have been looking at the record number of companies that are going through bankruptcies, that are closing, right? That are laying people off, that are never coming back. And so we look at all of that stuff, and, I kind of think through, well, what else is behind it? And we have discovered that for many of those, private equity owners are what's behind it. And we looked at some of the companies that we talked about, Neiman Marcus and so on. And while you thought that the scam is bad, and it's not scam, I mean, it's a legit thing of what they're doing, right? That's not the lie. Where the scam piece kind of sits in for me has to do with the fact that they will take over the company, a good company, a productive company, and then milk it dry completely. It's like a vampire sucking all of the blood out of the body, and next thing you go is like, the little, like everything is gone, and then just, that's it. That's it. That's the end of the game. And that's kind of what we're seeing happening inside the markets right now. Let me show you what I'm talking about. So, record number of companies drown in debt to pay dividends to their private equity owners. Wait, what? That's right. When they acquire you, they require the payments. And so now they are trying to squeeze whatever little bit of money is left in these companies. Let's take a look at what's going on. And this is part of that scary piece about this particular industry. Private equity firms were instructing their junk rated portfolio companies to get even deeper in debt and issue secured loans using the proceeds to pay dividends to owners, the same private equity companies. So it's kind of like, you have a business, right? And you have a company, and that company, that business is, you're already leveraged to your teeth, but, you have some equipment and maybe you own the store, whatever, right? And so now you're going to basically pledge that as a collateral to get a secured loans. And now when you get that loan, instead of using that for productive components of the business, such as, R&D, expanding inventory, improving marketing, selling more, hiring more people, getting better tech, right? Like those kinds of things that actually have a potential to bring you more money. No, no, no. You're going to take that money and you're going to pay your owner. That's right. So when you think that you own a business, but then you get a private equity company, well, you are no longer an owner. You are now a slave to them. In September, a quarter, 24% to be exact, of all new money raised in the U.S. loan market has been used to fund dividends to private equity owners, up from an average of less than 4%. That is crazy, right over there. After the Fed stepped into the corporate bond market, sending yield crashing to the record lows and forcing U.S. investors into the last corner of the fixed income world to fill some of the modest yields, which is leveraged loans. So here's part of the problem, right? So let's talk about it for a moment. We have a part of the problem is that number of these secured loans for companies that are already zombified, which means that they don't make enough to cover their debts, nonetheless the principal on that debt, right? So it's interest and principal, and they can't cover either one of the sides of the thing. Then the Fed basically said, well, not only are we going to zombify everything in the market, we're going to sort of flirt around with this stuff, which basically destroyed the yields, which then forced everybody to go in and play the yield game. So that's where people started jumping into the junk, into the leverage loans, into saying forget the bonds altogether. I'm going into stonks. So they're getting over there and getting basically killed and plummeted, and starting to play with the derivatives because people are trying to figure out where do I find leverage to keep up with everything that is happening right now, and also assuming that we're expecting and hoping, right, to get a little bit hot with inflation, right? So we're gonna run average more than 2% because we've been averaging less than 2%. Now, an interesting article that I have actually found that I didn't put it over here. I don't think I put it over here. It was just too much stuff. Like there's only so much I can show you without like running a full day, and even then we run way longer than I originally anticipate. But they were arguing that basically the amount of debt, which we're going to look at in a moment, the amount of debt that governments and corporations and individuals and so on cumulatively has been created, specifically governments, the 2% inflation is not going to do much of anything when these things come due. The only way to actually start eating into it meaningfully, the debt that we actually have printed thus far, trying to sort of navigate this whole like what's going on, and crash will still come anyways, it's just prolonged and a bit more painful right now. But they're saying it has to be 10% or higher. Well, if that's what inflation has to be, right, then we have to go in and prepare for that. And of course, some people are saying, well, you got to get into gold for that stuff. For me, I like real assets. I like hard money, right? Things that cannot be printed. I like to be outside of the system. But again, to each their own. To each their own. So, anyways, going back to this whole thing, because Fed stepped in, now there's a problem with this whole piece, right? And so people are starting to jump into super risky stuff. So here are two examples of what happened. A cloud computing company, ECI Software, which is owned by Apex Partners, will raise $740 million in new loans, of which $118 million will be used to pay for a dividend to its owner. Wow. That's about sucking it dry. And you know what? I'm going to say that this group right over here could really care less what happens with this one. This is just a money-making machine. Once it's dry, they will basically cut it loose, walk away, and the small investors and the employees and those, the rest of the folks are the ones that are going to suffer. Snack Foods maker Shares Foods, which in turn is a portfolio company of Wind Point Partners and the Ontario Teachers Pension Plan, raised over $1 billion in the loan market on Tuesday and used more than a third, or $388 million, to pay for a dividend to its owners. This is absolutely crazy. And the part that is really crazy is that it is, attached to the teacher's pension plan, which basically means that at some point, those teachers are going to be on a hook and losing of the stuff. If private equity sponsors can take money off the table, then they are going to do it. As long as the Fed manipulates corporate bond markets by picking winners and losers, which is what they do, they're not going out there and buying everything. They are picking and choosing. I will save you, you get to burn. Yes, you, and you. I mean, it's like a bouncer at the club. Have you ever done that, right? Where you go to the club, right, and you're all dressed up and you're waiting, and there's like a bouncer and stuff, and he would literally be like the side of who goes in, right? Now, of course, many other places like you sort of wait in line, and when you come in, you go in. But there are clubs, and I have definitely witnessed that. New York City actually comes to mind for one of those things. I haven't seen it much around other places in the world, but definitely New York City, where you literally stand there and be like, you, and you're like, but they just showed right? So that's kind of what's happening. They're picking winners and losers, deciding whose debt will buy and whose it won't. Wall Street will find ways to maximize the profits, and PE firms, private equity firms, will make out like bandits even as their portfolio companies drown, in so much that the bankruptcies and mass layoffs at the company level are just a matter of time. And I absolutely agree. And I believe that those that are currently in charge of all of this stuff are about to get even richer by making these zombies, sucking even more money out of them, and using them. And these zombies wouldn't. This wouldn't be a possibility if it wasn't for Fed. So Fed Powell is definitely assisting the wealthiest of the individuals in the world. And the question now comes in of, okay, that's great, but you're literally creating the divide that you publicly are stating, well, I want to correct that. I don't, how are you correcting that? All of the wealth, everything is going to the top. It's going to the top companies, top people, and the richest individuals out there who own all of these things and can basically suck everything else dry. Then you have these zombie companies that basically die off. They go away. They don't walk away. They go away. They disappear. People lose jobs. So that is not getting better employment. That's getting better and higher unemployment. And that's my personal opinion on this particular thing. And then finally, we do have a global debt which is exploding at a shocking rate. The legacy of the shock is debt, debt, and more debt. And in short, we're going to use more debt to fix debt. And you know what? You can sometimes do that to shock the market, right? It's kind of like if you had a little bit too much to drink last night and you wake up and you're like, ugh, I feel sick to my stomach. If you just take a little bit of alcohol, I'm not saying a lot, but a little bit, because what it does, it biologically it actually helps you, right? It sucks, but it actually helps you just to sort of like bring it to even. Or you shouldn't have been drinking that much to begin with, but too late by the time morning comes. Even though you don't want it, you take it as a medicine, and then water, water, water for the rest of the day, right? That's what actually gets you through. But here we are like a drunken sailors, which like, well, one shot, two shot, three shot, four, five shot, seven shot, right? So that's basically what we're doing here. Global GDP, debt to GDP level surged to an all-time high in first quarter of 2020. And remember, first quarter of 2020, it didn't even begin, this whole closure and everything else, until March, which is basically the last part of the quarter. So I don't even want to know what second part of or the second quarter is going to look like, or third for that matter. I think second is going to be worse. And the overall debt for the non-financial sector is now worth 252% of global GDP, which is up from 241% at the end of 2019. Biggest quarterly jump according to BIS data. And you can actually see right over here kind of, what's been happening in the last 20 years alone. 20 years alone. Here we go. This is coming, and this is coming from Bank of America Global Research, BIS, and its sample of 46 economies, non-financial sector only. So here we go. We had 07, 08. This is kind of when we were. So we printed money, right? Then the Eurozone debt crisis, right? And we printed a little bit of money. I mean, between 11 and 15, we've been printing quite steadily. We hit sort of this peak in, what does that look like? Mid 16. Then kind of decided to come down, but things were not quite working well, right? I mean, if this was a stock right over here, I'd buy it and I'd probably be winning. So as you can see, it's definitely performing really well. Like I said, it's performing just like a stock market, really, really well. Central bank inflation targets are higher, much higher than the official 2%. Oh, I did put it in. I told you all. Much higher than the official 2% to erase this debt. Central banks need inflation to be in the 10% plus range. Again, the only way that you can get out of that whole piece is that if this thing goes up and inflation does hit 10% and higher, and this is not the first time we're talking about it nor hearing about it, the only way that you can get through it and actually get your wealth is to invest in things that not just keep pace with inflation, but also potentially beat it. And then you do smart leverage, not this crazy leverage that we talked about just moments ago, but smart leverage where you have productive that gets eaten by the higher inflation, making your asset go up in the value and making your equity in it that much higher, that much faster. That is the game that at least I will be playing in this particular scenario. Now, will I be right? Who the hey knows? Will I be wrong? Who the hey knows? Anything is possible whatsoever. Now, let's go back and switch really quickly to wrap up the day. The sector governments, by sector governments, drove the big uptick in that GDP in the first quarter of 2020. Global sovereign debt to GDP ratio has reached 89%, up 10% points, which is the largest quarterly rise on records. And that is very, very scary if you ask me personally. And then, of course, I do want to share with you one particular piece. I'm trying to see if I can make this into the screen. Probably not. So we're probably going to have to, scroll together if that's okay with you. Take a look at this table right over here. So this is a table of global debt to GDP heat map, so to speak, right? And so right over here, you will see the countries, right? Right over here, you will basically, I mean, colors are pretty self-explanatory of what's happening. So the world as is right now, uh, so general government, households, non-financial corporations, private non-financial sector, and total, right? So you can look at a total and stuff, and then you can look at what's happening with the households and what's happening with the general government, and then the non-financial sectors. So first one is world, right? And it's not pretty. I mean, it's that like darker yellowish, not quite orange, but the government sector is much darker. Then you have DM, which is developed markets, right? They are a bit uglier than the emerging markets. Look, at emerging markets are not as ugly. They actually have some green. Then you have G20, which is very similar to the world, right? And then you can actually take a look at what's happening here within the countries themselves. And here is U.S. being the first one here with non-financial corporations doing pretty okay. Households not so much, and then government definitely not all that great. Then you have China where, the government is fine, the households are fine, but the companies not so much. And you can kind of take a look at what's going on. Germany seems to be doing pretty okay, but France is not. And then Luxembourg is like in deep, trouble right over here. But when it comes to government, it's doing amazing. So you can kind of scroll around and take a look as to what's happening, right? And you can see that there are some countries down here that are doing incredibly well. And that's India, Indonesia, Russia, Poland, Czech Republic, Turkey, Brazil, Mexico, Argentina are the sort of the countries that are doing better, right? But these are also countries that are, they're not as necessarily as much debt and stuff, but the problem with their debt is that it's a foreign debt. It's a U.S. based debt, and so if the prices and the price of their currency versus the U.S. dollar fluctuates too much because they can only rely on their own, but the U.S. dollar, relies on its own and stuff. There's a lot of a risk with the currency for them, and then also a lot of them that we just talked about have experienced and are experiencing ridiculously high inflation. So while it's helping with the debt because it's eating it, it's hurting the population and it's hurting their currency. As you can see, it's sort of, rock and a hard place, and we are standing between it. So, thanks for watching. We're about to jump into the Q&A. Let me know what you think. Let me know where you stand. Let me know what you think is going to perform incredibly well in the future. And I look forward to seeing you tomorrow, but only if you subscribe, you hit the bell button, and you hit the like. Until then, stay forever money blessed, and do remember, you are only one deal away.